Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are joined by Ben Gagnon. He's the CEO of Bitfarms. They just came out with their Q3 earnings, and that's going to be the focus of today's conversation. Before we get into it, take a second, hit the like button, you guys. It's a big help to myself and the channel, specifically in getting this content to other people like you who may find value. If you're not already subscribed, McNallie Money, feel free to join, and let us know in the comment section below what you thought of Bitfarms' results and if you're currently holding shares. With that being said, let's get into today's video. All right, guys, away we go. Q3 earnings with Ben Gagnon, hot off the press. We're going to be talking about the numbers, strategy, outlook moving forward. This is a highly anticipated interview. Very excited to get into it. Ben, always a pleasure. Thank you for making the time.
Yeah, happy to be here, guys. Always great to chat on your show, and really glad to talk about the progress we've made and what we're doing rolling forward.
Most definitely. Now, obviously, a difficult day in the market across the board. We'll address that in a second, but really the underlying fundamentals of your company, a lot of these companies in this type of sector couldn't be stronger. We've learned that throughout this week in Texas on our site tour. So we're excited to talk about the growth, the potential for Bitfarms. Before we do, though, can we start off with just kind of the high-level operational financial updates from the quarter or Q3?
Yeah, I mean, we had a pretty solid quarter. I think there's some confusion in our reporting with regards to our Paraguay asset. We've been working on our US pivot for quite some time. We obviously sold off our Iguazu site, earlier this year to Hive. We shut down our Argentina site, and we made the decision to put the Paso Pe site up for sale. So, we had $69 million of revenue across all of our continuing operations, but we also had $14 million coming out of Paso Pe. So we had $83 million of revenue, basically right on line with analyst estimates. But because of how IFRS works with an asset held for sale, I think everyone kind of pulled out that $69 million figure and ignored the $14 million. But Paso Pe continues to hash today, continues to spit out revenue and free cash flow from operations. So our mining margin was strong. We implemented some programs on the derivative side where we've been selling a lot of kind of short dated and long dated call options against the Bitcoin mining that we have in the Bitcoin that we have in treasury and the Bitcoin future production. And that's done really well. Like if you include that against our all-in cost of production, we go down from above 80 grand to like 55 grand, because we're able to capture a lot of value, de-risk the business, improve the margins. We did the same thing in October. On the rally, the big candle from 122 to 126, like we sold hundreds of call options near out of the money. It's made us millions of dollars, out of thin air, right? So it's a great strategy for us. It's a way for us to get more value out of every Bitcoin sold. It's a way for us to sell into strength, de-risk the business. And I think the mining operations has remained really strong. But I think the big focus in the quarter was, raising the significant war chest that we raised. I guess it took place in October, just after the quarter end, but we were able to raise over $600 million across the convertible note issuance and finishing up our ATM. We did both of those into strength. We were able to raise a war chest that is now, about $900 million in cash and Bitcoin. We have the $200 million facility with Macquarie that's still remaining. So we're sitting on about $1.1 billion worth of financial resources to deploy into HPC and AI. And I think that's the really big, number to highlight.
Yeah, you mentioned that capital achievement there, the 1.1 billion. How do you sort of prioritize the capital allocation between sort of like HPC infrastructure build outs, Bitcoin mining operations, and any potential strategic acquisitions out there?
Yeah, so we don't have any more planned miner capex. We've actually been, working down the Bitcoin mining business, right? We've been shutting down. We shut down Argentina. We listed the Paso Pay site for sale. We had about 3 different bids come in for the Paso Pay site, which could give us, somewhere between 1 and 2 years worth of estimated free cash flow from operations out of the site in the transaction for reinvestment in the US and HPC and AI. So there's a lot of areas where we're actually looking to scale back on the Bitcoin mining side of the business and really focus all that capex towards HPC and AI. And when you look at the Bitcoin mining business, it still pays for OpEx, G&A, debt service, and contributes to capex. So that 1.1 billion that we have, all of it goes to infrastructure. All of it goes to capex. It's not going to fund the business. It's all going to grow the business. So it's a really substantial war chest. And when it comes to M&A, really have no desire to be out there doing a bunch of M&A. We've got such a great portfolio of assets. The best value creation that we can have is executing against the development against that portfolio. We don't want to waste management's time and resources and our capital trying to chase other assets to develop. We're just focusing on developing the assets that we have right now. And at some point in the future, we'll get back, into M&A and looking to grow that pipeline. But we got 2.1 gigawatts to develop. We're focusing on developing that portfolio. And when it comes to how we're developing, that portfolio, we're focusing on timeline to energization, timeline to revenues, and managing the critical paths across various projects. So, we just announced our plans on Washington this morning, and we've secured the full supply chain to do that conversion. We've been securing a lot of the long lead time items across Panther Creek, across Sharon, and all these other developments. So we're allocating the capital to make sure that all of our timelines on construction are maintained, and we're executing against those construction milestones. We're obviously going to need to continue to raise more capital in the future as we execute against the construction, but that 1.1 billion gets us really far into the future and really helps to ensure all of our project development timelines are preserved and kept for many, many months from now.
A couple of questions before handing back to Bryce. One of them is the 200 million from Macquarie. Are there any sort of covenants associated with that, or is that sort of gives you just the ability to use it as cash as and when you're required to build out, a HPC facility?
So that is a project level financing facility, which means that we can only use it for development at Panther Creek. We can't use it at Sharon or Scrubgrass or Washington or anyone else. And really the only requirements for drawing down on that facility is bringing the receipts to Macquarie. As long as we are showing them the receipts of what we're doing and what we're spending it on, and it's contributing to bringing the phase 1 closer to completion and generating revenue, that's basically all that's required there to draw down further cash under that facility. So we've got a really substantial war chest that we're utilizing.
Yeah. And finally, from a sort of a financial reporting position, I believe you're planning to adopt US GAAP by the year end 2025. How's this sort of transition going to affect comparability of the historic results, and what financial indicators should the analysts focus on post redomicile?
Yeah, it's a big difference because, as a Canadian company, we're all under IFRS. So, almost all of the other companies in the space are reporting under US GAAP. And so there's some key financial metrics that are just very different across the two. The big one that comes to mind with any company that has Bitcoin on the balance sheet is FASB and what that means on a quarter-to-quarter basis. So, we don't recognize the gain and the value in our Bitcoin on a quarterly basis like US companies do. The other thing, as an IFRS company, we're not actually allowed to record the revenue from our Bitcoin mining operations as revenue. We have to record it as financial income. And so it's kind of a wonky way to report it. But those sorts of things will get normalized out when we move over to US GAAP, and it'll be easier for investors to compare across different companies in the peer group on actual numbers and actual performance. I think the big thing, though, that the US redomicile really enables is greater index inclusion. So, as a Canadian company, you really don't get the same level of index inclusion that you would as a US company. And when you look at where the peer group is, and you look at their cap table, and you look at how institutional investors are actually acquiring these, it's usually through the indexes. And just by moving over to the US, we should be able to get significant uptick in institutional adoption and institutional investment in our shares, where right now we're about 80% retail or so. That number is constantly moving and constantly changing. I mean, I think our float's changed over twice in the last 2 weeks because we have so much volume. So it's hard to keep track of those figures. But just moving over to the US means that you get a massive uptick in institutional investors. They tend to stay there longer. They're there for months or quarters, or years before they're really focusing on doing their rebalancing. And that really does help to improve share price and really helps to create a lot of value there for shareholders. So that's going to be a big value add for Bitfarms as we move over to the US.
Thank you.
It certainly is, and we've seen that with some of your peers in the space as well. Now I'm going to shift over to the HPC AI side of things. I've got a couple for you here as well, Ben. You can really feel the tone, the style of these investor deck presentations has changed quite a bit. You guys put on your first slide talking about the demand for megawatts, for gigawatts, HPC AI compute, and the fact that you guys are very sure that this is not a fad or bubble. Can you talk to us a little bit about why you're making that statement, what you're seeing from your level in terms of demand, and maybe why it isn't the best idea to go out and sign the first deal possible in this space?
Yeah, I'm really glad you asked that, Bryce, because this is kind of the key question that I think, all of these companies are facing. We're at like a very early inning here for this new wave of compute. And, it kind of goes back to like the parallel would be like before Google was really a search engine, you were searching with like Dogpile and Ask Jeeves, and, there wasn't really a proper way to search for content on the pages before Google came around and actually started crawling the pages and caching all this information. Now AI is like completely rewriting the rules of how humans interact with computers. Before computers or humans needed to learn how computers think and how computers think through their different processes. Like when my dad was in college, he was learning how to program on a flashcard. So you'd have to punch out flashcards. You'd have to have them in the right order. God forbid you drop the flashcards and they all spit out over the floor because it'd take you forever to recompile your program physically. And over time, that's gotten better. Humans learn programming languages, but to properly utilize compute, you needed to learn how to think like a computer and speak like a computer. Now AI flips that, and now AI enables computers to understand how humans think. And what that means in terms of reducing the human interface between the mind and actually using the compute is really quite significant. And so the data center industry is growing at a crazy rate. I mean, it has been for 20, 30 years. It's growing at exponential rates. This is something where it's only accelerating now that AI is rewriting those rules. And when the data center industry is growing, so are these lease rates that are associated with them. And so what we've seen is that over about 20 years, the annual lease rate growth is about 3%. Over the last 3 years, it's been 12%. And the reality is that there's so much more capital going into the compute and into the chips than there is racks available to plug them in. And so you end up with a dynamic where, let's say you spent, $5 billion in GPUs. And you're looking at signing a lease, and you sign a lease for, $150 per kilowatt per month. And that's what a lot of these leases over the last couple of months have been signed at. that means that you probably have a direct operating margin that's probably in the 80s or 90%. And that lease rate is maybe a low single-digit percentage of your direct operating cost. And so if that direct operating cost doubled, the actual impact on your direct operating margin is actually only going up by maybe a low single-digit percentage. And so are you still going to want to sign that lease if that's your only option to deploy your compute, which you've invested billions of dollars you need to monetize? Yeah, you're going to take a marginally lower margin in order to deploy your billions of dollars of compute. But for a company like Bitfarms, if that lease doubles, that's completely different economics, right? Our cost to operate one of these leases are largely fixed. And so if I go from $150 to $200, that doesn't mean that I'm just increasing my top line revenue by 25%. That means that I'm actually increasing my total profit margin percentage. I'm increasing my free cash flow. I'm increasing my multiple expansion that comes with it. And when you look at how these leases are structured, there's all these different value drivers. One of them is pathway and timeline to revenue. One of them is location. One of them is scale. One of them is the infrastructure that you actually have to support what kind of compute and infrastructure. One of them is the risks and the uncertainties associated with the development project. And so what happens is if we wanted to go out there and sign one of the leases, which is in my inbox today, we could get 140 kilowatt per month, right? That's what we could lock in today. But if we were to execute against the construction and, fast forward, we're, already there through all these different construction milestones, we could easily get $180 per kilowatt per month. That's a 28% increase, right? So I could take a 28% discount by locking in today. And what that means is that the risk and uncertainty is worth 28%. So if I can get rid of that risk and uncertainty, I can lock in a much higher number, and I can lock that in not just for 1 year, but for 5, for 10, or for 15 years. And that's really what, I think everyone should be focused on when it comes to leases is, not signing the fastest lease, but signing the best lease. And, there's a big difference between trying to lock in a value today and trying to lock in the most value over time. These are 5, 10, 15-year agreements. This isn't something that you should be trying to optimize on the short term. It's something that you should be optimizing across multiple years. And that means taking your time to do it right and maximize the value in our view. There's a few reasons why you would want to sign a lease today. I think, if you believe that HPC or AO is a bubble, yeah, you probably want to lock in the value that you could get today, but we don't think that's anywhere close to being accurate. We think that infrastructure is such a bottleneck, and HPC and AI is really just getting started, and it's backed by decades of data. So one, we don't think this is a bubble, so you don't want to cap your upside in something that's growing exponentially fast. I think two, if you don't believe your megawatts are very unique and very valuable, and somebody's got, 100 megawatts 10 miles down the road from where you've got 100 megawatts, and there's not a whole lot of scarcity around your asset, you might want to lock in an agreement today before the person 110 miles down the road locks in that agreement. None of that's true in our pipeline. We've got assets that have multi-year wait lists that are very, very difficult to secure the power we have secured today. And then the third one would be if you need that lease to raise capital to finance the development. And we're now raised all this cash. We're sitting on over $1 billion. We don't need to sign a lease in order to finance the development. So we're really focused on how we can get the best value out of that lease. We think that's the best way forward. That's what aligns us best with long-term shareholders. And just because you sign a lease, I think doesn't actually validate you as a developer operator. I think that's one of the big misconceptions in the market is sign a deal to validate that you can do this. But signing a contract doesn't validate that you can deliver under the contract, right? What it validates is market demand. It doesn't validate your ability to deliver. And what you see is that there's a lot of people who sign contracts that they can't deliver. And what we're focused on is how do we get the most value in the long term? How do we manage the risk the best way in our construction timeline? And we think with the strategy that we outlined today on the call, we're solving both, right? We're getting better value over time, and we're also not taking on unnecessary risk at this stage in the development, which could have significant, financial costs and impacts.
Yeah. Well said, Ben. And I wanted to actually kind of dovetail onto that point. So we've just spent the last 5 days touring all around Texas, looking at facilities in this state in the ERCOT market. You guys have quite a unique portfolio in terms of megawatts. So can you talk to us a little bit about exactly what you said there? How rare these megawatts are, these sites that you have, and what differentiates your portfolio maybe from the guy that's 100 miles down the road or with a similar site in another market?
Yeah, I mean, there's a whole lot of value associated with location. There's a reason why Data Center Alley exists and why so much of these data centers keep being built in the same area, despite not having a bunch of power, despite having very expensive power, despite having very expensive land. It's because being close to each other creates value in itself. And so when you look around at where our sites are, they're all either existing data center hubs, or in the case of Pennsylvania, it's a big emerging data center hub. They're all in cool, dry climates. And the natural benefit of being in a cool climate versus a hot desert-like climate like Texas means that we spend less money on CapEx and less money on OpEx for cooling. And so more of our megawatts are actually going to generating revenue. So our megawatts in the areas where we are, they're closer to where the market demand is. They're closer to where all these other data centers already exist. They have the natural climate benefits, which means that we can spend less on CapEx and less on OpEx, and they produce more value per megawatt than a similar megawatt would in a place like Texas, right? If you're operating on a 1.5 PUE versus a 1.2 PUE, that means that you're just not making as much revenue on the same amount of megawatts. And so there's a huge value add in being in the areas that we are. And it's just impossible to get these megawatts that we've secured. In Moses Lake in Washington, it takes 10 years to get this power because it's the cheapest power in the United States for data centers, and it's 100% renewable, and it's close to Seattle, Portland, and Vancouver. So everyone's there, everyone's on the wait list, but you can't jump the wait list. They're not giving priority to a hyperscaler just because they're a hyperscaler. And it's a very bureaucratic process. We have this very similar dynamic. There's also very cost-effective, stable hydropower rates. There's some of the cheapest power in North America for data centers. You've got all the benefits on cooling. You don't have the same sort of tariff risks, associated with the United States, where every week it's kind of changing around. And so you've got a real stable environment. But if you want to get more than 5 megawatts in Quebec, you have to go and get it approved by the government. And it's a very bureaucratic process. They've denied several data center projects in the last year. They just came out this week, actually, and said, we're actually all in on HPC and AI data centers now. We want them to come in, but they want Quebec companies. And so, we're sitting there with a unique portfolio of assets, an asset that's able to grow the entire data centers industry in the province by about 25%, because it's only about 700 megawatts today. And, we can solve 2 strategic national and provincial objectives: scale back the Bitcoin mining megawatts that they don't like, increase the HPC and AI megawatts that they do like. And so this is a kill 2 birds with 1 stone sort of situation for the province. It's a great opportunity. We just confirmed our path forward on the conversion, and so we're accelerating our plans in Quebec. But it's very difficult. Like, Google wants to get in there, they can't get in there. Microsoft wants to get in there, they can't get in there. Amazon wants to get in there, they can't get in there. We're already in there. And so that brings a tremendous amount of value, just have that secured. And in Pennsylvania, where we've got the most power, this is an area where there's been huge announcements coming from major data center developers. Amazon's committed $20 billion to 2 sites nearby. CoreWeave's committed $6 billion to a site nearby. And we already have all this power secured at Panther Creek and Sharon. And so that means that, we're able to avoid all this regulatory uncertainty. We're able to move forward with construction. We're able to execute against our timelines. And when you're able to save people time, and you're able to save customer or ensure that customers are able to deploy their compute faster, there's value created in that. And so there's these are real strategic assets. It's not like, somebody can just go and put 300 megawatts down 30 minutes away from where we already have the power secured. Those power applications were made in early 2024. So if you want to do that today, like, you are actually looking at a much longer queue. You're looking at maybe getting the power approved in 28 or 29. And then you have to do construction after that. So you're looking at 5-6 years of timeline to execute against what we can do in the next, 12 to 24 months.
You've been very busy today, Ben. You've had an earnings call today. You've also released information about Washington and the actual the construction that's going to take place there to deliver that sort of like that first HPC model that you're going to produce there. And the cost of doing this, $126 million for the build out process. Can you sort of like talk us through the build out in terms of that cost there, the GPUs cost, any risks associated over the next 12 months in delivering that project, and sort of a very high level terms of payback, how long it's going to take to pay back the cost of implementing this strategy there?
Yeah, and we're really excited about what we announced in Washington this morning. This is going to be the first site that's fully competed, the first site that's going to be generating HPC and AI revenues according to our expectations today. We locked up the full supply chain. We had the construction team there in Washington with the general contractor today. This is a really exciting development, and what's really new about the Washington site is we talked today about, for the first time, is going cloud at Washington. Now, we haven't fully confirmed that we're doing cloud, but we do think it's really compelling. What we have is basically a couple of reasons why we want to do that. One, we have the cheapest power for data centers in the United States at that location. So if we did a co-location agreement, that benefit would get passed through onto the customer. So that makes it easier to market the site. But if we go cloud there, we capture the full benefit of having the cheapest power for data centers in the country for ourselves. And so that means that we get higher margins and better return profiles than we would, in a place where the power prices could easily be 4 or 5 times what the price is in Washington. The next benefit is that by doing this build out at Moses Lake in Washington, where it's relatively small on 18 megawatts, we're able to learn the full stack across just developing, operating, how we're running the GPUs, the software, everything. We can learn all of that at a scale that's much easier to execute against. And when we're looking at developing against 2.1 gigawatts, it's really helpful to actually validate yourself as a developer operator and learn all of those lessons at 15 megawatts. This goes back to what I was saying around signing a lease. Like, signing a lease does not validate that you can develop and operate. Yeah. Developing and operating validates that you can develop and operate. That's the only thing that validates whether or not you can develop and operate. And so this is a way for us to, learn all of this in a way that's easy to execute against, easy to finance, much lower risk because of the scale. And then, we can apply those lessons across the rest of our 2.1 gigawatts of development portfolio. And that means that we should have lower risk, which means we should have better lease rates, which means we should have better economics, better outcomes, and easier time in terms of actually getting all those sites marketed, all of that capacity sold. So there's a lot of benefits, on the periphery around that. And then when you just look at, what are the direct operating margins for a site like Washington that has the cheapest power for data centers in the country, like, these are like 89% implied margins with GB300. So just that one site, which is less than 1% of our portfolio, could produce more net operating income in a year than we've ever done with Bitcoin mining. And so this is something that we can consider fully funded today. We've been speaking with GPU manufacturers around GPU sourcing and financing. We believe that it's highly probable that we can get really attractive terms on 100% GPU financing, so we can keep the CapEx limited to the same cost that we would build out colo. But we now have a much stronger free cash flow foundation that replaces the Bitcoin mining business, funds OpEx, G&A, debt service, and contributes pretty meaningfully to CapEx rolling forward for all of our other projects. So I think it's a really exciting development. I think it's going to help us, not only with that free cash flow foundation, but that knowledge foundation. And I think it's going to pay dividends across, all of our other site developments.
Are there any risks or bottlenecks that you're sort of like monitoring over this next 12-month period? I mean, you talk about hopefully getting financing arranged for GPUs. Have you, in conversations where you can actually access the GPUs in the time frame that you need them to fulfill the service you're going to deliver at Washington? Are there any other potential things that can affect not just you but other sort of like facilities, in terms of if you don't manage these things correctly, you could be left holding the bag, and how are you sort of like planning to mitigate the risks?
Yeah, I mean, there's always risk in construction and managing the timelines, right? You have to manage your critical paths very, very closely. And even if you manage your critical paths very closely, there can always be delays for things that are outside of your control. So, the best ways that you mitigate risk is by working with great partners on the ownership side, on the general contractor side, working with people who have great experience, who know the area, who know the local regulations, who know the local permit offices, to make sure that all of that is proven capabilities across everything. And then you have to make sure that you've got a great internal team who's also managing those external vendors and those external contractors, because just having great partners is not enough. You also have to manage the relationships. You need to stay on top of them. You need to make sure that they're delivering. But we work with great partners, and we're not a company who's ever represented that we're going to try and do everything internally. We work with great partners wherever we can in order to deliver better outcomes and better probability of successful outcomes. And so that's the best way to manage those risks. There's nothing that you can identify in construction ahead of time like that, because otherwise you'd already be working to address the risks. The biggest risks in constructions are just the things that you can't foresee, the things that happen, outside of your control, a weather event, a change in something, change in tariffs, and that impacts all these different other things. But what we've done is we've secured a supply chain. We've secured the right partners to help us with this build out. And we've got a really clear path forward at that Washington site. And then with regards to, all of our other developments for 2027, I think focusing on Washington and focusing on getting that first site online and really building that out and having that strong foundation is really important. But when it comes to all of our other sites, like, we're trying to lead the industry in the development of the next generation infrastructure. And I think that's one of the key things for us as a business, because everyone's really focused on Blackwells right now, and everyone's really focused on 150 to 190 kilowatts per rack. And when you look at the next generation, it's upwards of 370. And so if you're building for the compute that's being shipped today, by the time that facility is complete, it can be obsolete. And so what we're trying to do is we're really trying to focus on playing the long game. And the way that we're going to get the most value, we think, out of our development portfolio is, trying to optimize across these variables, timeline to energization, building the right infrastructure when it's going to be in the most demand and the least supply. And that's what's really going to be able to lock in those prices. But, this is brand new infrastructure. Even NVIDIA has not completed their reference designs for the next generation infrastructure. They're expected to be shipping or to producing their first Vera Rubin GPUs in Q2, but they're going to take the first several months of production for themselves. And so sometime in Q1, NVIDIA is expected to have a very firm view of what it's going to take to actually operate these GPUs successfully and for the long term. and we're going to be implementing that across all of our 2027 development portfolio. So
And just final for clarification, this doesn't stop you from actually doing anything, say, at Panther Creek in terms of being able to utilize the project funding to start delivering infrastructure there in readiness for a future client to probably come and sign a deal.
No, we're able to execute against all of these infrastructure goals right now. And then when it comes to accommodating Vera Rubin, it's really a lot of the more internal mechanics, right? It's how do you do the internal electrical distribution? It's how do you manage the internal distribution of the fluid for cooling? Like, it's all of the stuff around the energy density of the facility itself. And so a lot of stuff that we can be executing on, if you look at that critical path in the project management timeline that I outlined, like, that's not impacted at all by moving over to Vera Rubin's, with the exception of trying to get something online by 2026, right? If you want to get something online in 2027, you're not impacted by that. But it's not reasonable to assume that you can wait through Q1 to get the final reference designs from NVIDIA, implement them into energy engineering plans, implement them into your supply chain sourcing, your procurement, and have it all installed and up and running at the end of December. And so, this also ties into why we think that this is going to be the most in-demand infrastructure with the least supply and the greatest economics. And this is why we're focusing our entire development, well, not our entire, 99% of our development portfolio is going to that kind of infrastructure.
Yeah, sure.
Now, you just talked about the fact that the Washington facility is decked out for the Grace Blackwell platform, the GB300s. You alluded to the fact that your flagship Panther Creek is more geared to the Vera Rubin platform. Now, we've seen technology advance very quickly in the ASIC marketplace. We're seeing that exact same thing in the GPU space. So my question there is around payback periods and around the cost to actually retrofit or upgrade these facilities if and when that rack density needs that additional push. So can you talk about, I guess, your expected payback period at Washington and how you're thinking about the depreciation on these GPUs versus that upgrade cycle?
Yeah, so a few different elements of that question. When you're looking at payback periods for infrastructure, it's different than payback periods for GPUs. And how you use financing in your projects also is going to have massive impacts in terms of your expected payback period. When you just look at, let's just take Washington, and you want to go full cloud, and you look at, what is the expected net operating income that we might get at Washington, we're looking at like a 2 and a 2.5 year payback period, but that could be improved with financing. So there's really, really attractive economics associated with that. Now, that's assuming today's economics. In 12 months, the economics could look completely different, but the payback period is pretty attractive. And I think what we've seen is that, and we saw this in Bitcoin mining, like, the way forward is really the commoditization of compute, right? When you look at Bitcoin mining doesn't price itself in S21 XP per hour, right? It prices itself in terahash per second. And when you look at the GPU market right now, the GPUs are GB300s per hour, H200s per hour. But when you look at what they're actually being measured against, it's tokens per second. And so there's already a similar metric in HPC and AI, which is a computational throughput per unit of time. And what's going to happen is that probably through the software layer with hyperscalers, is they're going to find a way to commoditize all of this compute. And they're not going to specifically allocate it across individual units of equipment. They're going to commoditize it. They're going to figure out a way to do the load balancing across really larger fleets. And what that'll mean is that you're going to be able to extend the economic useful lifespan out of this hardware. It's something that we saw happen in Bitcoin mining. It's something that we absolutely see happening in HPC and AI over the next couple of years. And so we think that that's probably going to improve the lifespan, improve the payback periods, and really, really juice the return profiles on getting into that hardware. When it comes to looking at the different infrastructure investments, those are slower payback periods. It's less CapEx, it's less revenues, the margins are still very attractive, but because you're taking on less risk, you are getting less reward. And so those are longer payback periods, but the trade-off there is that the infrastructure amortizes over a much longer period of time. Now, the challenge with amortizing something over 15 years when the infrastructure requirements are changing every 12 to 24 months is a real challenge. And so the way that we're addressing that is we're saying, well, we need to build out to the best foreseeable spec that we possibly can forecast. And that's the Vera Rubin architecture and the Vera Rubin GPUs. So that alone is the first thing that you do. Then the second thing that you do, we think, is you want to minimize your payback period. And the way you minimize your payback period is with, cost effectively financing the build. And then 2, locking in the most value in the lease, right? If you lock in a higher value in your lease, your payback period is shorter, your risk is less. And if you're going to push the boundaries, a lot further on the lease, that also means you should probably have a lot more bargaining power in the lease at the time because you're solving a bigger problem. If I'm trying to sign a lease today for future capacity in 18 months, I'm not solving a big problem. If I'm signing a lease for, delivery in 6 months, I'm signing a really big problem, right? And so solving that problem has a lot of negotiating benefits beyond just the lease itself in terms of all these other additional terms and conditions around when somebody might be able to renegotiate and how long I can keep them in there for that contract. And so I think, our strategy is fully geared around how do we best take advantage of a dynamic that is quickly evolving, it's quickly growing, and really create that value for the long term.
Yeah, that's great, Ben. Now, another question I had for you based on our travels here, we've heard from a number of different executive teams that the backlog in these various different energy markets around the United States is getting quite extensive. You just alluded to that in some of your data center markets as well. In terms of the capacity that you guys have in your pipeline, whether that's development or future projects, what kind of risk is associated with those megawatts? Are there additional hurdles or compliance measures you need to meet, or is it essentially what we see is what we get here in terms of that pipeline?
Yeah, so for most of our pipeline, it's fully secured. There's only 2 areas of our pipeline where there's risk on the power delivery. One we spoke to earlier today for the first time is we now have a new phase 3 and phase 4 at Panther Creek. So we have 350 megawatts secured. That's contractually guaranteed. It's coming. That's confirmed. And nothing is going to happen to change the contractual obligations on the electric utilities part to deliver us power under that agreement. Now, beyond that, what we had was we always had a power plant on site, and we had what's called an ISA, an intermediary service agreement. And so, that's what's actually providing power to our Bitcoin mining operation at the Panther Creek site. We either opportunistically, draw power from the grid or sell power into the grid. We collect capacity payments from the power plant, which are, at record prices because of the huge demand in the PJM area. And we just got, positive indication actually that we can convert that over to a firm ESA. Now that requires no infrastructure. It requires no further investment. There's nothing that really needs to be done other than signing some paperwork. Now that's subject to approvals by the utility and by the regulators, but we got positive indication that is finally moving out of kind of this unknown into we want to actually progress this and move this over to firm service. So that phase 3, we don't have the exact timeline for when it could be increasing the power from 350 secured to 410 secured. But for the first time in over a year, we now have visibility on making it secured. Additionally, beyond that, we have a new phase 4 at Panther Creek. So beyond the 410, we're actually going to be completing another load study. And so what's happening is that the utility is actually looking at building a bunch of new generation in the area to meet the demand. And one of the things that they're wanting is data centers to be primary off-takers. So we were one of the first calls by the utility to see about how we can increase power on site. And so we have a clear pathway to go from 350 to 410 to 500 plus megawatts at the Panther Creek site. And so the 350 secured, the additional capacity has some work to do. And we classify that as under application. So if you look in our MDA, we've got 3 buckets of power: energized, secured, and under application. And that's kind of how it falls across those 3 buckets. Beyond that, the only other site in our portfolio that's not 100% secured or energized today is our Scrubgrass site. And our Scrubgrass site is probably going to be the best site that we have. This is a huge site. We've got 650 acres. We have a power plant there. We've just completed 3 conceptual load studies with First Energy, the last one being for 750 megawatts. It's moving over to the detailed load study, which would, after the detailed load study, it would move over to that firm contractual obligation to deliver power under what's called an ESA. And so once it's at that point, that's a firm commitment by the utility to deliver power according to the contract, according to the timelines, according to the budget that's outlined there. In addition to that 750 megawatts at Scrubgrass that we're moving forward with the detailed load study, we also have the second largest natural gas pipeline in the United States, 3 miles north of our power plant. It's called the Tennessee Natural Gas Pipeline, owned and operated by Kinder Morgan. We've been working with them for several months around the deliverability of gas. Effectively, we'd have to build about a 3 to 4 mile pipeline. We're working on the last piece now, which is going underneath the river. That's the most complex engineering piece, is going underneath the river. But we have initial budget forecasts for that. We've got timeline forecasts for that. And now we're working through how we actually convert the gas into electricity for generation on site. But that's 550 megawatts of additional generation capacity on that site. So, that's the only power that's really unsecured. That's all falls under our application category. But that's a 1.3 gigawatt potential gigacampus. And outside of Texas, those are really rare. You don't see that kind of scale happening everywhere. You see a few hundred megawatts here and there, but that kind of scale is incredibly, incredibly rare. And one of the benefits that we have is, recently we've had a lot of developments like the 403 letter from the Department of Energy. You've got a bunch of announcements within the state of Pennsylvania, where they're actually trying to accelerate interconnection agreements for data centers who are bringing generation. And so, all the buckets are really lining up really well for Scrubgrass. There's still a lot of work to secure that power and to make it contractually obligated. But, all green lights across our developments there at Scrubgrass. We think that's going to be the crown jewel, but that's probably 2028 and beyond. We still think that plays in really well with our development, our long-term investment thesis, the development cycle. But that's the one area where we can't really call our power fully secure today.
Just to follow up on that, Ben, there before we get into finance, I'm assuming you mentioned a river. Is that where you'd access your water from?
So we have, we're kind of on a peninsula. So the rivers kind of go like a snake, and we basically own this peninsula. So we do have water rights under the river. I think one of the misconceptions with data centers and water usage is that they consume a lot of water. I mean, they can. There's different technologies available for cooling. There's open loop systems where you're just running water through, and there's closed loop systems. And I think most of the industry has moved over to closed loop systems. And it's not just about the energy efficiency or the water efficiency and the water utilization, but it's also a cost benefit, because what happens if you're pulling water out of the river means you need to treat the water, and you need to process the water, and you need to make sure the water is clean enough to run through your systems, because otherwise it's going to gum up your systems. It's going to shut down your cooling, which shuts down your data center, which costs you a bunch of money. And so having a closed loop is actually easier to operate and easier to maintain. But we do have water rights at both but both of the power plants that we operate, both Scrubgrass and Panther Creek. Actually, at Panther Creek, we actually do treat a lot of the water for the power plant itself, but that's an environmental benefit that we just choose to do. There's a lot of what's called acid mine drainage water in the area. It's very toxic, but the plant has treatment facility built up for that. And so, we had Senator Argyle out there on site and Representative Heffley out there on site, and they both mentioned polluted water in the area. And, I said, well, we've got this treatment facility. We haven't been using it, but, let me look into that. So we did that. We've been operating that. We're making some improvements to that to operate it at full capacity rolling in spring. But that has the ability to treat almost a million gallons of water a day of kind of toxic water and stop it from going into the local creeks and the local rivers and the watershed. So it's a huge environmental benefit. And that's something that we can do with, very minimal cost. And really is a great, way for us to give back to the community in the area as well.
Thank you. At the start of the conversation, we talked about the financing and this $1.1 billion. And as we've been talking through the conversation, I've been trying to do numbers just in my head really about obviously the Washington, the 18 megawatts there, the 126 months pay for that, then the GPUs on top of that. That could be probably circa 300-400 million there. In terms of levers to pull now we know from the update today that the most recent ATM has now been utilised up there when the share price was at a reasonable position as it is compared to where it is today. What are the levers going forward now? Do you feel are available to you? And looking at how some of your peers who've managed to land contracts and then get financing literally immediately after the contract because apparently a number of doors are open for them to deliver that. What are the options and levers available to you going through 2026 now, as you're going to need more capital to develop other sites other than the Washington site?
Yeah, so I think the first thing is, one, how far does the 1.1 billion get us, right? It gets us fully through Washington. It gets us through the first phases at Sharon and Panther Creek. And so that 1.1 billion, especially with moving some of that objective back into 2027 in order to accommodate the Vera Rubin technology, means that we've got a clear pathway, well through Q2 of next year to be executing against everything with a lot of flexibility and with a lot of time to be raising additional capital. And as we execute against the construction milestones, there's going to be other opportunities as well to bring other financing tools into the mix. We recently just announced Jonathan Murr, who's our new CFO. Jonathan's been doing this for about 30 years, where he was an MD at Lazard. He was an MD at Bank of America. Like, this guy has spent the last 3 decades structuring financing and debt deals for energy infrastructure projects. So, we brought somebody on who is very, very well experienced, who has a great, network of different infrastructure funds and different groups that we can tap into, who knows the other side of the negotiating table so that we can ensure that Bitfarms raises, the best capital from the best parties at the best possible terms. And there's a tremendous amount of options on the table for us. There's project-specific debt financing. There's, additional convertible issuances in the future. There's, there's junk bonds associated with the projects. There's all sorts of different structures in which that you can raise additional capital to finance the build outs. And so, as we roll through Q1 and Q2, we'll be looking to, raise funds strategically. Not trying to do everything with equity, of course. We are trying to maximize value creation for shareholders over the long term. So, that means utilizing a variety of financing tools and being smart about when you use which financing tool in order to get the best advantage over the long term. So, we've got the right team in place. We got the right guy who's going to help us out with that rolling forward. And, he's only been in the job 2 weeks. So it's a little early to comment exactly which, debt instruments and financing strategies we're going to implement. But, we'll have more updates on that in the Q4 call in Q1.
I'm just hoping with that 30 years plus experience, he's still got a few more years left in the tank before he's thinking of retiring.
Oh yeah, he's roaring to go. He's super excited about the job so far. He's a great addition to the team. We're really excited to see, how we all work together and what we're going to be able to accomplish together as a team. But, when you're looking at the total returns for these projects, raising capital at the right times and right prices is crucial. And, having the right person there to help us manage that process is a critical path. And, we're really happy to have Jonathan on board.
Only as good as a team, Ben. Only as good as a team.
We got a great team, Anthony.
Absolutely. Yeah.
I was going to say, that's one thing we've heard consistently down here from each of the miner sites we went to. So Ben, congrats on the quarter. This was a very informative conversation, a lot of context or color added to the Bitfarms story. Anthony, I'll throw it back to you for a final question, then we can let Ben wrap up.
Thanks very much, Bryce. Ben, you're probably, I'm going to say, the person in the public mining space that's been tinkering with mining machines longer than anybody. I'd like your view as to a two-part question. I'd like your view as to where you see Bitcoin mining in the next sort of 2 to 2.5 years from the public sector mining space in North America. And secondly, are you even considering co-locating mining alongside data centers to balance the power load when the HPC data centers aren't using, their full load, because you'll work out the power based on the maximum required, but never ever maybe use that maximum all the time.
Yeah, I'll answer your question in reverse. And the answer is whether or not we're still considering that, because I think we were actually the first company to talk about that. We worked through the engineering and the maths on that, and we don't think it actually is optimal anymore. It made a lot of strategic sense when we were first thinking through the math, but the reality is that you've got to spend so much money to overbuild the CapEx, and you don't get more value associated with the Bitcoin mining for all of that additional CapEx. Where you're getting the most value is the conversion of Bitcoin mining megawatts to HPC and AI. So if you've got to have both simultaneously, it really is not the same, economic value creation tool that we thought it would be, 12 months ago.
Yeah.
What's going to give you better value in our view on the megawatts themselves is just ensuring the uptime, because you get paid to ensure uptime. And so, batteries are actually the better solution over Bitcoin miners for HPC and AI. You're going to do some combination of batteries and gensets, but batteries are actually better than Bitcoin miners if you're trying to maximize the value creation in HPC and AI. And if you're trying to maximize the value per megawatt, you're maximizing it with HPC and AI, not Bitcoin mining.
Yeah.
Now, the first part of your question was, where do I see the industry going? And I see the industry going exactly where I said it was going to go 4 or 5 years ago, which is integrating into the energy infrastructure itself at a much more distributed and small scale. Because where Bitcoin mining makes sense is where it can absorb the inefficiencies in the system already, right? What you don't want is to be, going out there, I think, and trying to build a brand new substation and build new transmission line and build this new infrastructure just to support a Bitcoin mine. What you want to do is you want to go where all of that infrastructure is already built and it's just being underutilized. And so, I think that still plays out in terms of electrical generation companies. I think that still plays out in terms of distribution transmission companies, where they've got substations around the area for regional distribution, where they can pull load off the line, they can monetize it. And when you are looking at those models, you're no longer trying to maximize the value per unit of energy. What you're trying to do is you're trying to monetize the most units of energy for the least amount of value. And that means that you're not trying to buy the brand new miners. You're trying to buy, 5-year-old S19s for 50 cents a terahash, right? That's what the model, right? And so you're going to be running really old equipment a fraction of the time, and you're going to be absorbing these inefficiencies. And I think that's going to be true across, electricity companies. It's also going to be true across the natural gas companies. And, we've been pushing this flare gas concept as an industry for a long time. I was out in Alberta back in 2018 trying to explain flare gas mining to oil and gas companies. And it was such a foreign concept. This digital pipeline is the term that I use. And now it's being adopted en masse. And now we're seeing that, large scale Fortune 500 gas companies are starting to utilize this. We're seeing state-owned sovereign, gas companies starting to utilize this, right? All across the Middle East, there are gas companies who are utilizing this. That's the trend. And it's going to focus on lower and lower and lower cost energy, which means marginal cost energy, which means that you only want to utilize existing infrastructure and absorb surpluses where they are. You don't want to invest in new infrastructure for Bitcoin mining. So it's a very different game. I think when it comes to, the public miners have built up these huge portfolios of power. And when you're looking at how do you actually exercise against your fiduciary obligation and your duties to maximize value for shareholders, it's really hard to justify expanded CapEx in Bitcoin mining right now, given the opportunity in HPC and AI. I mean, we have multiple offers in my inbox today for infrastructure that we have. And, even though I think we can do significantly better on those offers in the coming, quarters, it's way better than Bitcoin mining is today, right? And so there's a huge opportunity here. There's tremendous upside associated with this. There's the ability for you to grow your company predictably over years in a way that Bitcoin mining never facilitated, because the underlying volatility made it really difficult to forecast more than 12 months. And so I think the public miner game I think it's going away. I think the only public miners are going to be public energy companies with small amounts of mining. And, it's going to go to sovereigns, and it's going to go to transmission companies and midstream companies who need to monetize an excess and solve a problem, not companies who are just Bitcoin mining for the sake of Bitcoin mining.
Unless you got a wind farm accessible, maybe they could use one as well. So I suppose there are options.
It's one of those areas where you could have, excess capacity, right? Yeah. So that falls into the category like wind farming, surplus wind farming could fall into the category like flare gas mining.
Yeah.
Just not as predictable as flare gas.
Yeah, we've been traveling hundreds and even thousands of miles this week across Texas, and Bryce and myself have been noticing the wind farms, and there's thousands of wind farms all across the route we've taken today, and it's amazing to see how many aren't actually switched off. And the reason they're switched off is because there's no demand for the power at the moment. So, maybe what you're saying there is an alternative for some of these wind farms. And we know some of the likes of like Soluna have attached their strategy to work alongside wind farms, albeit on a scale that they're working at. But it seems to be driving dividends for them. But I think you're right in your analysis there. For me, it's the difficulty that kills it. I mean, people think about a halving every 4 years. I think about the difficulty every 2 weeks. And that's the challenge. And in the last last 3 or 4 months, I think we've had 7 upsides in difficulty and only a couple of shortfalls. And it's hurting the miners, whether being public or non-public miners, getting the production that their hash rate suggests they should be having.
Yeah, it's a trend that's inevitable. If you look at the rolling forecast or the rolling historical difficulty adjustments, it's about 2% per difficulty adjustment. And that's what we use in all of our forecasts. That's been incredibly accurate. When you look at what we forecasted in the past and rolling forward, it's what we used as our primary input for hash rate assumption growth back when we put our forecast assumptions in the Q4 deck in March of this year. We forecast Bitcoin price, network hash rate, and mining economics and direct mining margins through 2025 and 2026. And, very few, I think we're the only public miner who did that, but the math is very clear that the hash rate estimates have tracked right on time. But the Bitcoin price is the one thing that, nobody has a crystal ball on. And if they did, they'd be retired. But, from a growth perspective, yeah, it's really, really difficult to grow a company like that. It's very different when it's, a fraction of a percent or 1% of your business. It's very difficult when it's 100% of your business and it's all in all the time.
Yeah, no, great to get your response to that, because you've been in the space doing this for longer than the majority of people, and I take your analysis very, very strongly as well. But no, thanks for that, Ben.
I was going to say the same thing. Yeah, it's always a pleasure to have you on. Your wealth of knowledge and experience in the industry. We wish you all the best there, Ben. Appreciate you dropping in on the channel. I'll give you the opportunity to close out, and thanks for another excellent interview.
Yeah, thanks, guys. It's always a pleasure to be here. We're super excited about what we're building at Bitfarms. We think we've outlined a really clear long-term investment strategy and how we're executing against it on our quarterly call today. I know there's a lot of demand from investors to sign a lease faster and to sign a lease, tomorrow. There's always demand for putting out a press release tomorrow. But, a lot of the times I think the interest of somebody who's trying to day trade the stock and the interest of somebody who's investing in the long term are not aligned. And, as a business and as a CEO, like, I can really only focus on long-term investors. I can't be focused on trying to appease, day traders every day. I need to be focused on long-term shareholder value creation. And, that means I need to be really focused on doing what's right for the long term, even if it's not fully understood by the market, on a day-to-day basis. And, when I look at the trends of the industry rolling forward, and I look at, the data that we've had over the last couple of decades on this, I look at how we apply the lessons from Bitcoin mining to HPC and AI, like, we're just at the very beginning days of this. We're just scratching the surface. And so, it feels like the comparable in our industry is like, if you're selling away your upside now, if you're capping your upside now through the premature signing of a lease, it's like you don't have the vision, about what this industry is really going to do over the long term. It's like Zuckerberg, accepting $1 billion from Yahoo to sell Facebook. You don't do that when you understand what the long-term industry is going to do over the next 1, 5, 10, 15 years. If you know that's what's going to happen, you do everything in your power in order to realize that vision. You don't try and cut it short. And so, I think that's the big difference between, our approach and maybe what a lot of our competitors have done, and maybe something that the market doesn't fully understand or appreciate. But I'm really confident that the strategy that we're utilizing, the decisions that we're making, in 12 months from now, nobody's going to look back on these decisions with regret, right? You might look back in 12 months on capping your upside and signing a lease prematurely and, limiting the value that you could create or taking on this unnecessary risk. You are not going to look back on these decisions with regret. You're going to look back on these decisions. You're going to say, wow, I'm really glad I did that.
Patience is a virtue, they say. Thank you so much for the time, Ben. Again, you guys, if you have any additional questions, feel free to leave them in the comment section below. Phenomenal interview. Hit the like button. Feel free to subscribe. We'll see you back here tomorrow.